scheduled rate of corporate news flow will step up a gear in the coming week as fourth quarter results start to come thick and fast in the USA and trading updates come at a steady rate here in the UK. On this side of the pond, names and statements which may be worthy of further note include the following: Marshalls on Monday the 19th of January, Rio Tinto, Cranswick, Kinetic, Kia and Gear for Music on the 20th, Experian, Huxchild Mining, Currys, Elementis and JD Wetherspoons on the 21st, Harbour Energy and Wizz Air on the 22nd, and to round out the week, Record on Friday the 23rd. But the biggest fuss in the week ahead may just come from JD Sports Fashion and B&M European Value Retail, whose Christmas updates are due on the 21st and 22nd respectively, while stateside, Netflix's fourth quarter and full year results are bound to draw headlines when they come out on the evening of Tuesday the 20th. Netflix will always draw a crowd, even if it's not one of the so-called Magnificent Seven, and the timing of the results is intriguing for two reasons in particular. First, the company is locked in a battle with Paramount Skydance for control of Warner Bros. Discovery. And second, the shares have been weak since the summer and have barely gained over the past 12 months. Now, perhaps that's something to do with the putative Warner Bros. Discovery deal, given the complexity of the transaction and the likely regulatory process, and also the risk of buyer's remorse, which has already been suffered by AT&T and AOL when they took their turn at buying Warner's. A forward price earnings multiple of some 28 times for 2026 could also have something to do with it, too. Either way, attention will now switch to organic growth and how Netflix is using its prime content to keep subscribers happy and streaming and rival providers at bay. Analysts and shareholders will look to these fourth quarter figures for 2025 and any guidance for 2026 for reassurance. In terms of the headlines, the consensus analyst forecasts are as follows: fourth quarter sales of $12 billion up 17% year on year, and that will take the full year total to $45.1 billion, up 16%. And then also fourth quarter earnings per share or EPS of 55 US cents, up from 44 cents a year ago, but down for seasonal reasons from the third quarter 60 cents. That will take the full year total to $2.56, up from $2.03 in 2024. Should co-chief executives Greg Peters and Ted Sarandos update prior guidance for 2026, then the current analyst consensus is as follows: first quarter sales of $12.2 billion, up 16% with earnings per share of 83 cents, and full year sales of $51 billion, up 13% year on year, with EPS of $3.21, up a quarter year on year. Now, Netflix's share price isn't looking so happy, and neither's that of JD Sports Fashion. The FTSE 100 firm's shares languished near 5-year lows thanks to worries over tariffs, soggy consumer confidence, competition, and softness in the athleisure market, where key partner Nike is yet to show much evidence of improved trading momentum. November's profit warning didn't help either, and much will now depend upon how any guidance from Chief Executive Rudy Schultz stacks up against downgraded analysts' forecasts. For the year to January 26, analysts looking for adjusted pre-tax profit of £850 million, down from $923 million, ahead of a recovery to between $850 and $900 million in the year to January 2027. The trends in total, organic and like-for-like sales growth will also be telling. Total includes acquisitions, organic includes new store openings, and like-for-like is as it sounds. Like-for-like sales fell 1.7% year-on-year in the third quarter, and analysts forecast a 3% total growth for the year to January 2027, look to assume growth from space and not much on an underlying basis. As a final point, note that JD Sports has just completed a second £100 million share buyback, although Mr. Schultz is likely to leave any talk of dividends and capital allocation until May's full year results. Finally, we come to B&M European Value Retail, whose share price looks sorrier still as it sits at all-time lows. Long-term worries over the company's exposure to lower income bracket families, and thus those whose spending power is most crimped by inflation, and hot competition from both the big supermarkets and online rivals like Amazon, Temu and Shein, crystallise in a torrid 2025. Profit warnings, the departure of the chief executive and chief financial officers, a dividend cut, were all topped off by autumn's trading alert, when management admitted its operational systems had failed to correctly recognise £7 million of freight costs in the first half, with the result that full-year income would undershoot estimates by some £40 million. All of that overshadowed new boss Chair Yegan's turnaround plan, and shell-shocked shareholders will be just hoping for no further nasty surprises in this Christmas and third quarter update. Two numbers to watch in terms of the third quarter and any guidance for the fourth quarter and full year to March are like-for-like sales growth, which was minus 1.1% in the second quarter. Analysts looking for further drops of 3% and 2% year-on-year in the third and fourth periods, with total sales seen rising by just over 1% to 1.7 billion in Q3, with the UK B&M brand flat. France actually up by some 10%. Also look at management's preferred profit measure, which is, for better or worse, earnings before interest, tax, depreciation and amortization, or EBITDA. Back in October, B&M cut guidance to between 470 and 530 million pounds for the current financial year, down from 619 million pounds in the prior 12-month period. Thank you for watching. Hope that you and your families are all keeping well, and I look forward to seeing you again next time.